everyone, and welcome. Today, we are going to build a financial stress test. Think of it as a personal game plan to help you survive and, you know what, maybe even thrive during a major market correction. It is an absolutely crucial skill for any investor, but honestly, it's one that very few people actually take the time to practice. First things first, let's get some perspective here. A market correction, say a 10% drop, that's not some once-in-a-lifetime event. It happens on average about once a year. A bigger one, a 20% drop, usually comes along every few years. So the very first step is to stop thinking of these as shocking surprises and start seeing them for what they are, a regular part of the cycle. It's like the seasons changing. You prepare for winter, right? Well, you've got to prepare for this too. You know, the investor Anthony Bolton just hit the nail on the head with this quote. When the market's soaring, it's so easy to feel like a financial genius and completely ignore the little cracks in your foundation. Things like having a bit too much debt or maybe not quite enough cash on hand. A bear market doesn't create those problems. It just flips on a very, very harsh spotlight and shows you exactly where they are. And that leads us to the big question, doesn't it? How do you find and fix those cracks before the storm actually hits? Well, the answer is to shift your mindset. You've got to go from being a reactive victim of the market to a proactive planner. And you do that by running your own financial stress test. So let's walk through exactly how to do that, piece by piece. Okay, so for most of us, the real danger isn't the market correction itself, it's how we react to it. We tend to panic, we make these gut-wrenching emotional decisions, and it's all because we fundamentally misunderstand how the market cycle actually works. When things are good in a bull market, it's so seductive to think of the market as this steady one-way climb to riches. But the reality? It's much more like a roller coaster. You have to remember, the market is just a giant collection of human emotions, and it naturally swings back and forth between optimism and pessimism. These cycles aren't just possible, they are absolutely inevitable. The legendary investor Peter Lynch really understood this. He knew that during a downturn, it's your stomach that matters more than your head. All the brilliant intellectual analysis in the world means nothing if you don't have the emotional grit, the fortitude to actually stick with your plan. Like he said, the key is to not get scared out of your stocks. It is a gut check, not an IQ test. Now, before we even whisper the word portfolio, we have to talk about your personal finances. Look, you can only build a resilient investment strategy if it's sitting on a rock-solid foundation. Seriously, this might be the most important analysis you will ever do. I want you to think of these as the 7 vital signs of your financial health. Together, they tell the whole story. You've got what you bring in, your income, versus what goes out, your expenses. The difference is your cash flow. Then you have what you own, your assets, versus what you owe, your liabilities. And that gives you your net worth. And finally, your credit score, which is really just a measure of your financial reliability. You have to know these 7 numbers like the back of your hand. No excuses. So here's how all those numbers fit together, like puzzle pieces. Your income and your expenses, that's your monthly income statement. Your assets and liabilities, that's your personal balance sheet. If you have negative cash flow or a weak net worth, that is a serious, serious crack in your foundation. And trust me, a bear market will find it and it will exploit it. You have to fix it first. All right, once that personal foundation is solid, the next battle you have to fight is an internal one. The greatest enemy to your investment returns isn't Wall Street. It's your own psychology. It's the constant tug-of-war between the greed and the fear that lives inside every single one of us. The investor Howard Marks has this brilliant analogy of a pendulum. He says the market is always swinging between 2 extremes. On one side, you have euphoria and greed, and on the other, you have depression and fear. But here's the crucial thing to get. The pendulum almost never rests at that sensible, happy midpoint. It's almost always moving toward one of those emotional extremes. And those extremes, they create these powerful voices inside our heads. At the market peak, when everyone's making money, greed and that fear of missing out, FOMO, just screams, buy before you miss out. But at the bottom, when things look terrifying, fear screams, sell before it all goes to zero. Both of those voices are wealth-destroying emotions. The successful investor learns to recognize them and then learns to ignore them. Okay, so with a strong financial foundation and a disciplined mindset, now and only now can we start to design a resilient portfolio. The goal here isn't to build something that just works in the good times. We're building for the storms that we know are coming. The key word isn't predicting the future, it's preparing for it. So this here is a classic example of what's called an all-weather portfolio. And the goal isn't necessarily to get the absolute highest returns. The goal is to perform reasonably well no matter what the economic climate is. See, stocks do well when the economy is growing. Long-term bonds do great when growth and inflation are falling. And then assets like commodities and gold can help protect you when inflation is high. The idea is that some part of your portfolio is always working for you. It's all about balance and survival. So now it's time to stress test your actual holdings with this checklist. Ask yourself, are you truly diversified, or are all of your eggs in that one tech basket? Are you maybe way too concentrated in a single company? And this is critical. Do you know what's actually under the hood? You have to check the balance sheets. Companies with huge debts are incredibly vulnerable in a downturn. It's like a car speeding on an icy road. It doesn't end well. Now, rebalancing is one of the most powerful and kind of counterintuitive tools that you have. Let's say your target is 60% stocks and 40% bonds. Well, after a huge bull run, you might suddenly find yourself at 70% stocks. Rebalancing forces you to sell some of those high-flying stocks and buy more of the underperforming bonds. It's a system, a process that forces you to sell high and buy low, the exact opposite of what our emotions are screaming at us to do. So far, we've talked a lot about preparation. But what do you do when the correction is actually happening, when the headlines are screaming, crash, and your account is just bleeding red? In that moment, a clear, predefined action plan is the only thing that can save you from pure panic.
Imagine it. The screen is a sea of red. Your portfolio is down 20%. Your gut is just screaming at you to get out, sell. This right here, this is the moment of truth. If you don't have a plan, you are lost. But if you do have a plan, it's not a crisis. It's simply the next step in your process. I want you to think like an emergency room doctor doing triage. Step 1, stop the bleeding. This means using risk management tools you've already set up, like a stop-loss order that automatically sells a stock if it drops to a certain price. Step 2, stabilize the patient. And the patient is you. Go back and reread your investment plan. Remind yourself of your long-term goals. And only then, in step 3, can you calmly shift from defense to offense by consulting your watch list. And this right here is a critical piece of your offensive strategy. A market crash is the absolute worst time to start doing research. Your emotions are just too high. The smart investor creates a shopping list during the calm times, a pre-vetted list of fantastic companies with strong balance sheets that you would love to own if you could just get them at a better price. When the correction hits, you don't have to think. You just check your list to see what's on sale. And all this brings us to the final and maybe the most profound mindset shift of all. Because for the prepared investor, a market correction isn't just something to be survived. It's a rare and incredibly powerful opportunity. Warren Buffett offers what might be one of the most important ideas in all of investing. He says if you're a net saver, which just means you'll be buying assets for years to come, then falling prices are your absolute best friend. A crash is literally a 40% off sale on your future wealth. You get to buy more shares, more assets, for the exact same amount of money. You shouldn't be scared, you should be excited. So let's just quickly recap the whole framework. First, remember, downturns are a when, not an if. They're normal. Your best line of defense is a solid personal balance sheet. Your greatest asset, by far, is your emotional control. And finally, the preparation you do beforehand. Building a resilient portfolio and having that shopping list ready is what transforms a crisis into your greatest opportunity. And we'll leave you with this one thought. The next correction is inevitable. It's coming. The only real question is, will you be prepared? Will you be a victim of your emotions and the chaos? Or will you have a plan, ready to turn that fear into a fortune? The choice is yours.